A few months ago, I got a call from a retired doctor. Not a struggling borrower, not someone with bad credit, but a successful physician with substantial assets and multiple businesses that he'd invested in. He had been eyeing this beautiful home in his neighborhood for years, and it finally went on the market. The problem? When he went through the traditional mortgage process, his income looked too complicated. Multiple businesses, K-1 income, ownership interest, distributions, tax returns that just didn't tell the whole story. On paper, he looked far less qualified than he actually was, and a bank actually turned him down. This is one of the big problems in mortgage lending today. Some of the people who make the most money are actually the hardest people to qualify through traditional lending processes. But here's the crazy part. He came to me and we ended up getting him approved using almost none of the income that the other bank was worried about. Instead, we qualified him primarily using his assets, specifically his retirement and investment brokerage accounts. So today I'm going to explain how that works, who it's for, and why working with a mortgage broker can just open doors that banks and credit unions often don't even know exist. Most people assume mortgage qualification is simple. You make money, you show your income, you get approved. But that's really only true for W-2 employees or some basic self-employed or 1099 borrowers. The more successful you become, the more complicated things often get. Maybe you're a business owner. Maybe you receive K-1 income. Maybe your CPA is just doing a great job at minimizing your tax liability. Or maybe you own multiple businesses, and all of those situations are true many times over. Maybe you've got substantial investments but relatively little taxable income using loans that you take off your assets to live on. The irony is that the borrower with a $100,000 W-2 job can sometimes be far easier to approve than somebody worth millions in investment accounts that their financial advisor's been suggesting to them for years. And that's where many banks hit a wall. Banks generally have a very limited menu of mortgage products. If you fit inside the box, that's great. But if you don't align with their mortgage products, then their answer is just often no. Now, differently than a bank, a broker just approaches the problem differently. Instead of asking, does this borrower fit this loan? We ask, which of these loans will fit this borrower? It's a completely different mindset and a shift in perspective. Now, on the broker side, one of the tools that we can use is called asset depletion. And honestly, it's one of my favorite examples of why mortgage brokers are so much better in many situations. Now, here's the simple version. Instead of focusing entirely on what money is coming in each month, which is what most banks are going to do, we look at the assets you already have, your savings, checking, brokerage accounts, retirement accounts, investments. Then a lender may allow us to convert a portion of those assets into qualifying income. Now, before anyone jumps into the comments, I'm going to preface a few things. No, this does not mean you're spending your savings or your checkings. It does not mean you're liquidating your investment or retirement accounts. And no, this is not something that's available on every loan program. But for the right borrower, it can completely change the conversation. You're not liquidating your assets. What's happening is that underwriting is asking if, and it's a big if the worst case scenario happened, could this borrower liquidate assets to pay for the mortgage? They're essentially saying that they're going to take your word that you have enough monthly income to cover all your debts, including your mortgage, as long as you show that you have enough assets that you could pay them all by liquidating those assets if you had to. Now, asset depletion isn't 100% unique to mortgage brokers or even non-traditional loan types. You can sometimes integrate asset depletion into a traditional mortgage, even if you're going with a bank, but only in very specific circumstances. The real magic here is the asset depletion loan, where you're not integrating asset depletion into another income qualification process. Instead, we're only using asset depletion. We don't even look at your other income sources to get qualified income. That's the piece that banks really can't touch. Now, I'll give you a real life example here, and obviously I'm going to change some details to protect privacy, but this is going back to my doctor client I mentioned at the start. So this guy, he had substantial assets and multiple income sources. His tax returns were messy and his ownership interests were very complex and the distributions were very complex. And we were working through his income. We were going to qualify him the traditional route, but every time we answered one underwriting question, we'd get one or two more that would pop up. And honestly, that's not too uncommon for high income borrowers. But many high income borrowers are frustrated at how complex the residential mortgage process can be, especially if they've had experience getting commercial loans. Underwriting is just very stringent. There's so much focus on it, and there are endless rules that we all have to follow regardless of how successful you've been. And the more successful someone becomes, there's usually even more and more layers that are added on top of it. So instead of fighting all those rules to qualify every piece and every income stream, we step back from the income and we asked a different question, which was, what if we don't need any of this income at all? After reviewing all his assets, we decided to use the asset depletion strategy. And the result is that we generated enough income from his assets that almost all the other challenges we were facing with his income just disappeared. He got approved, he bought the home he'd been eyeing, and the process was dramatically cleaner than trying to force the file through a traditional route. So here's the nitty-gritty details of this if you're interested. This was for a specific loan type with a specific lender, so I can't guarantee these exact same guidelines would apply or that this would be available to you, but his retirement accounts, we were able to total them all up and multiply that number by 80%. Would have been more, but he was young and a number of years away from retirement. So we had to do that 80% multiplier and then divide by 60 months. So for example purposes, we'll say he had $2 million in retirement accounts. Using that calculation I just mentioned, his retirement accounts gave us about $26,600 in qualifying monthly income. Now he had some other debt, so we needed a little bit more income. So we moved from his retirement accounts onto his brokerage investment accounts. And we did the exact same calculation, but instead of 80%, we were able to multiply it by 90%, so it's a little more favorable, and then divide by 60, which gave us $14,000 in monthly income. And voila, without liquidating anything, we were able to give him enough income to qualify for this loan. So this strategy can be worth exploring if you're a high earner like a physician, a lawyer, a business owner, entrepreneur, a retiree or an investor, someone living off of assets, someone with substantial retirement funds, or anyone whose tax returns don't accurately reflect their true financial strength. It isn't right for everyone, but if you've ever looked at your finances when trying to apply for a mortgage and thought, I've got plenty of money, why is it so difficult to qualify? This may be worth exploring for you. And the biggest takeaway I'd offer here isn't actually asset depletion, as much as I love it. The big takeaway, I think, is that there's more than one way to qualify for a mortgage. So if you're working with a lender that only offers one solution or a handful of solutions, there's going to be a lot of scenarios that are just impossible for them. But as a mortgage broker, I have access to dozens of lenders and hundreds of loan programs. And sometimes the difference between an approval and a denial isn't your finances. It's just finding the right strategy and the right partner to work with. So if you've been told no, or if your income is complicated, please feel free to reach out to me using the link in the description below. I'm always happy to chat. You guys have probably heard it before, but you can schedule a call with me and we can talk through your scenario and find out what's available for you. And as always, I really appreciate you guys watching, so please be sure to like, subscribe, and share with anyone that you think might find this helpful. Until next time, take care.